Now I hand over to Damien, CEO of Custom Credit.
Thank you, everybody. So I'm Damien Burke, CEO and founder of Custom Credit. I've had 24 years experience in financial services, primarily in credit risk and lending. I'm an approved person with the FCA, so SMF 1 and 3, and I'm here to tell you about Custom Credit. 22 with a consumer lending license, and we've been revenue generating since June 23. Okay, so what's the problem? So traditional lenders have an abundance of data which they really do not use. This is particularly with regards to initial affordability assessments and ongoing assessment of both affordability and credit risk. Where they do try and use data, there's a massive lack of understanding. So one of the examples I've given before is where effectively a lender I was working for as a consultant was trying to identify income shock through COVID. But they didn't understand that the data they were using actually was designed to even out what that income pattern looked like, so effectively create a good average. There's a lack of flexibility in term structure, so even if they did understand that affordability changes over time, they don't do anything about it. Classic example here is a customer that earns overtime 10 months of the year, and because of the averages that are used in the affordability assessment, effectively they're given a loan which they can't afford 2 months of the year. And immediately they go into arrears, they get higher charges, they get higher interest, and it's a terrible customer experience. And what we believe is that that actually leads to customers that are not engaged and are also higher credit risk. So our mission. So we've got 3 mission statements here. The first is to become the most customer-centric fintech in the UK. Now that's an ambitious task or mission. And what I kind of like about it is, when do we ever know we've achieved that? Right, we've got to keep going. We've got to keep trying harder. One way we do this is to try and make sure our colleagues reflect our customers. So actually we're hiring from a more diverse group of individuals so that actually we understand what's going on in their lives and how they can relate to our customers. And we include them in the decision-making process. So actually they feed back, because as you might imagine, a lot of the decision makers in financial services firms aren't actually users of those products. The final mission statement is around literacy. So we want to encourage our customers to understand our loan product first of all, but then other products more generally. Again, we believe that leads to a situation where they are lower credit risk. They understand and they're more engaged with the product, so we give them information about their open banking data, for example, and their own personal affordability trends throughout their life, to try and help them stay with us over time and actually keep coming back. You know, give a real positive experience of what that lending product can be. So we're here today to ask to raise a portion, at least, of £2 million. I'm very lucky that we've been able to raise nearly £1 million so far, and also lucky that the investment group that I've got are very supportive, and one of them's here today. We're going to use those funds primarily to cover operational costs and also contribution towards lending. So we've currently got 350k of secured committed facilities for debt funding, and they obviously come with advance rates, so we need equity to cover that. We've also got another 1.7 of effectively uncommitted facility that we've already confirmed with that lender, and we have a letter of intent from a bank for 11.5 million euros. So you can quickly see where that money goes in terms of funding our plan. And that plan covers the next 9 months. What we've used the money for so far, you can see a breakdown of below, but what's probably significant is that there's around 30% of that which is pure R&D, which we've done now, right? So most of the money now goes towards actually growing the business. Okay, so a bit about the product. Why is it different? So when we calculate the customer's affordability, we actually create a normal monthly payment, which all other lenders do, but we also create a flex low and a flex max, and that forms part of the customer's terms and conditions. The flex low is effectively to be used when they're a bit short, which will happen in some months, and the flex low is effectively to help them catch up, right? So we communicate with the customer regularly about what the flex low is going to cost them, because it will cost them a small amount of additional interest, because it's all based on current outstanding balance. And we advise them when they have that additional cash to pay their flex max and what that will actually save them in terms of money. Because the flex low and the flex max are part of their terms and conditions, first of all, they don't go into arrears if they use the flex low. And because we've created or co-created or implemented a variable recurring payment structure, we don't actually have to ask them for further consent. They agree at the start to pay between that flex low and that flex max. Here are our growth plans. So what does it look like for custom credit? I'd say this is conservative. If you listen to other lenders in our sector, they'll have much more ambitious growth plans. But the reason we've done this is really because we want to test and learn. Go slow before we're into BAU and real strong growth. And that's reflected here. So we're targeting from around 20 million in our first 12 months. I mentioned the funding facilities talking about at the moment. They cover the first 9 months of that. By the end of year 5, we're looking around 280 million in terms of a loan book. We believe that the reason the way to go about this really is to make sure that we have a well-controlled book, because it helps with funding and further raises if necessary. Market outlook, so 21 million adults in the UK have personal loans, and 12.9 have low financial resilience. So that means that they're the sorts of people that do have a lot of exposure to overtime and bonuses and that sort of thing. Now, to achieve the success on the previous slide, we actually need 0.3% of the market share by volume and 0.5% by value. So easily achievable in terms of the current market.
Perfect. So thank you very much, Damien, for the great presentation. So let's open up to questions. So who's got a question for? Yes, please, Claire.
Thanks very much, great presentation. 2 questions really. Are interest rates fixed or floating? And what is the impairment looking like on the book so far?
So our interest rate is fixed. The impairment is 0 at the moment. We've only got 10 loans out the door, and that is part of our slow growth plan. If I'm honest, we want it to be further along, but unfortunately the aggregator that we integrated with first of all doesn't really cross over in terms of our credit risk. Now, I've been in the other side of this, where I've been part of a lender through a consultancy, where they've got a lot of money and they've tried to get it out the door quickly to try and hit those targets, and it always ends badly. So we're trying to make sure that we develop our time, or focus our time on development of the right aggregator relationships and making sure that the through-the-door population meets our overall risk profile.
Perfect, yes. Second question. Is there another question for Damien? Yes, please.
Hi. Can you please speak up? What's your target customer profile and what sort of distribution of consumers?
Okay, so the target profile is quite broad. We are looking at near prime lending. So typically our customers will have a experience score of 721 and above, and effectively are a fair credit rating. Typically the interest rates are below 29%. We're currently tracking at 24.9. So that will tell its own story around the kind of risk profile. Where we believe that the customers will really find the value in this is, as I say, those customers that have bonus or overtime as a heavy component of their salary. There are, as I say, from the FCA's own surveys, there are around 13 million customers in the UK that fit that sort of profile where they have a regular income. And as I said, the market potential far outweighs our ambition in terms of covering it.
Good response. So, final question. Maybe to ask your investor, I think, why did you invest in Damien, in custom credit, and are you following on in this round?
So I've known Damien a long time, so I guess that helps. Why custom credit? I guess my background is in financial services consultancy for credit risk. I've seen a lot of lenders, and it's surprising stroke depressing how generic the lending proposition is. They're all loads of sliced bread, they're all the same with different value. And this is actually a different product. It's not crazily different, it's not overly complex to understand what's going on, but it's a variation, it's a configuration that allows some bespokeness to the customer's actual need rather than just being a repeat. And yes, I am following.
Thank you. So thank you very much, Damien.
Thank you, everyone.